Why haven't you refinanced yet? We're going to ask that question. We're also going to talk about where the rates are at today and where the rates are headed and why they're going that direction. This is David Pixler, and you're watching The Argo. Hey everybody, welcome to The Argo. Thank you for joining me here today. My name is David Pixler with Argonaut Real Estate and Mortgage, managed by Platinum Financial Services. I am planning on putting videos out like this at least once a week for educational purposes only. Everything expressed in these videos is my opinion and my opinion alone. I will be quoting some statistics and facts that I'll be finding from third-party sources, and I'll put those links down in the description below so that you can check those out for yourself. So let's ask that question. Why haven't you refinanced yet? Are you waiting for rates to get lower? Do you feel that maybe you are afraid of the process? Do you think you don't have time to put the paperwork together that you need in order to make that happen? If you're in an interest rate right now in a mortgage for your home that's higher than 3.5% or at 3.5%, you really should consider refinancing. With the way the market's going right now and the things that are happening, we may not see interest rates get much lower than they are currently, and they've already come up from their all-time lows. Currently, we're hovering right around 3%. When we talk about where the rates are at today, Freddie Mac, which is a government-sponsored corporation that securitizes mortgages that they buy from lenders and then sells them off to investors. They do a weekly survey of mortgage rates they've been doing since the 1970s. And according to them, the 30-year fixed mortgage interest rates are hovering right around that 3% mark. They were, in January, a 30-year fixed was actually got down to an all-time low of 2.625 on average. That was the average rate, 2.625. Now they're hovering right around that 3% point. And in April, they actually had gotten up to about 3.18. So they've come back down slightly since then, but they're still predicted to go up going into the end of this year and then even going further into 2022 and beyond. The Fed just came out and made an announcement, in fact, that they plan on raising the interest rates that they charge to the banks to lend money in 2023, which when they made that announcement, oh man, the market went nuts, and all of a sudden rates jumped way up. And I say way up in a sense of, you might see fluctuations of an eighth or maybe a quarter of a point in a single day, but they jumped up almost a full point from some of the banks that I was looking at, which is not something, at least in my experience, that I've seen a lot of. That happens when there's news like that kind of scares investors. So with that news that had come out, that was actually, they're saying that they're going to adjust the rates sooner than they had planned originally. So that caused a big stir in the market, which again, the rates spiked up. They've come back down slightly since then, but we're still not even down 100% down to where they were prior, around that 3% mark. We're still hovering right above it at like 3.25, 3.125, somewhere in that range. So if you haven't refinanced yet, if you have a 3.5 or higher, you still have an opportunity to get yourself down to maybe a 3%. You could possibly go lower. It's not that you can't go lower. It's just going to depend on how you structure the loan, and you might have to pay some points for that. Depending on the bank that you use and, the advisor you talk to and how they structure the loan for you. It may end up costing you some money, but if you're going to stay in that loan for an extended period of time, it would be well worth it to do so. If it's something where you feel that you're going to end up selling the house in 5 years, or, you're going to move in a couple of years, or maybe you're going to refinance again, you think, because you're going to take some money out in the future to do some work on the house, things of that nature, then buying discount points, getting your percentage rate lower by paying for it like that doesn't really make sense, because you're just kind of throwing money away at that point. It's better to do that if you plan on holding that loan for an extended period of time, because that interest that you save on the back end makes up for the money that you paid on the front end. Hopefully that makes sense. Some of the predictions that we're seeing, so from Freddie Mac, the MBA is another basically corporation that has put out a prediction. The MBA is a Mortgage Bankers Association. They've put out their own predictions on rates, but the Freddie Mac's expecting rates to get to about 3.4% on average going into the end of Q4 for this year, and then going all the way up to 3.8% on average going into the end of Q4 for 2022. That's a pretty big jump. You're talking almost a full point on average going into the end of 2022. When you look at the MBA and what their predictions are, they're actually predicting it's going to go much higher. They're looking all the way up to 4.4% by the end of 2022. That's pretty high when relative to where we're at right now. So again, it's one of those situations where if you haven't refinanced at this point, you really should look at getting that done. Someone like myself can completely and totally help you out with that. I can walk you through the whole process, talk to you about the rates, talk to you about the money that's going to cost you, if it's going to cost you anything at all, and get it taken care of, before they get higher and you're stuck in the rate you're in. Some of you out there even have what's called mortgage insurance. Maybe you finance with an FHA loan, or you did where you put 3.5% down. That's how you got into the house in the first place. Or you did a conventional loan, you only put 5% down. In some instances, people put down even 10%. If you put down less than 20%, you're paying mortgage insurance. There are a few exceptions to that, but for the most part, you're going to pay mortgage insurance if you put down less than 20%. Now, mortgage insurance is money that you're paying to another company to ensure that the lender that you're using gets paid if you default on the loan. If you lose your job or something happens where you don't have any more income and you can't pay for that mortgage, that lender gets paid because it's insured. Now, if you have more than 20% equity in the home at this point, you should be able to get rid of that mortgage insurance. Some cases, a mortgage insurance payment is pretty high. There are a few instances where maybe it's only $100 or $150, but that's still money that you're paying to someone else that you don't need to be paying to that person or company. I've actually been working with a customer that has almost a $300 a month mortgage insurance payment. That's just refinancing to get rid of that mortgage insurance is a big deal. That's $300 a month in your pocket. I mean, imagine that's $3,600 a year. Imagine what you could do with that. Put it in a savings account. Go out and invest in cryptocurrency like everybody's doing right now. Do something else with that money to make money and not just pay someone else. So if you're in that situation, it's a good idea. Even if your rate doesn't necessarily go down 0.5%, if you get it down 0.25%, you save a little bit of money on the payment because the rate's lower. If you're getting rid of that mortgage insurance, it's well worth it because that mortgage insurance is just, if you don't need to pay it, you're just wasting money. You're throwing money away that you don't need to be throwing away. And again, you can use to invest in other things. Some of the things that are driving rates higher is inflation fears. That's one. When inflation hits, the value of the dollar is lower, which means the banks are making less money on that money. So they start charging higher interest rates to make up for that. That's one of the reasons that you see interest rates start to creep up. So even if the Fed, now understand something, the Fed does not dictate what rate the bank lends to you. The Fed dictates how much they're charging the banks to basically lend to each other. Okay. So if the Fed comes out and says, hey, the rates are down to near zero, that doesn't mean you're going to get an interest rate at near zero. That means that it's costing the banks a lot less money to lend to each other and to borrow the money they're borrowing in order to give you the loan. But they're still going to charge. They have to make money too. That's why they're in business. So they're going to charge you a higher rate. So it all depends on what's going on with the market, everything that's happening, announcements that come out from the Fed, all sorts of fun stuff. So we sit and watch the rates all day long and we watch how they fluctuate. Typically speaking, a bank's only going to change the rate maybe once or sometimes twice a day. It's not unheard of to see them change the rates twice a day, but there has to be a relatively significant market fluctuation for that to happen. But that being said, if those rates do change, they don't typically change a lot. Getting back to what I was saying before, if the rate that you're getting from the bank is going to be higher than what the Fed is lending the money at, right? So don't expect that, if just because the Fed's not raising their rates, that the banks aren't going to continue to raise theirs. With inflation fears and with what's going on with economic growth right now and the jobs reports, don't expect to go into 2022 with rates going lower. They're going to get higher. It's pretty much inevitable that inflation is going to happen. It is happening right now. They actually stated the other day that inflation was higher than they expected it to be going into this point. Now, the Fed is still saying that they think that this is just temporary inflation, and a lot has to do with COVID and what's going on with the market and people going back to work and, the money that's getting spent. Again, this is just my opinion, but the government is dumping so much money into the marketplace right now that I don't see how we can stop the inflation at this point. There's just too much money being pumped into the marketplace that's driving the value of the dollar lower. And again, in my opinion, I think that's going to continue through 2022 and going into 2023. And that's why we're going to see, part of the reason we're going to see interest rates continue to climb. So in my opinion, if you have an opportunity to get yourself refinanced, do it. Don't hesitate. Don't wait anymore. Just do it. Get in touch with me. You can leave me a message here in the comments. You can DM me, my Instagram, my Facebook. All of my social media accounts are going to be in the video so that you can see the links. I'll actually put them in the description below as well so that you can see those and you can contact me directly. And I'll have my business card pop up at the end of the video, so which I'll have my phone number and my direct email so you can contact me directly. I can help you out with this. I can take care of you. I'll make sure that you have the best rate that you can possibly get at this point. And just give me a call. We'll discuss it. If you're looking to buy a home, one of the things that is of concern right now is with rates continuing to increase, they're also expecting that property values, or they're predicting, that property values will continue to increase going into 2022 and possibly 2023. That is kind of a toss-up as far as I'm concerned. There's a lot of other factors that go into that. There are things going on in the background that a lot of us aren't paying attention to, as far as like with lumber prices, the number of houses being built in a year or this year, and the people that can afford to buy a house right now and what's happening with all that. That's going to be a driving force in whether the values of homes continue to rise or they start to fall. My opinion is they can't rise forever. They just can't. It's not possible. So eventually they're going to come down. Do I think we're going to have a market crash? No, not like we did in 2008, 2007. I don't think we're going to have a crash. Are we going to have a situation where prices dump down pretty low relatively quickly? Yes. I think that they're going to come down relatively quickly, maybe about as fast as they went up, but I don't think it's just going to drop 50 or 60 grand in a month or two. Back in that 07, 08 timeframe was scary. I had two homes at the time and I lost both of them because of the market crash. So I know exactly what happened and how it happened, and I don't see that happening going into 2022 or 2023. But I do see the prices eventually coming down. And a lot of it's just going to be because people just simply can't afford housing prices. In places like Orange County, LA, where the property values are really high as it is, people are just getting priced out of the market. You even start getting out into the Inland Empire and you're already starting to see houses going for $500,000, $600,000, $700,000 where they didn't used to be that high. They're $300,000, $400,000, $500,000, for really big homes, nice places out there. And now a lot of those spots are going for way more than they have in a long time. So that's really driving buyers out of the market and making it difficult for people to be able to afford a home. Now, that being said, if you're in a position to be able to go out and buy a home, you're thinking about buying a home, I wouldn't wait. Things are going to cool off. More houses are going to come on the market. You're going to get more inventory. Builders are building again. Lumber prices are coming down. I feel like prices are going to start coming down relatively soon. I can't put a number. I can't put a date on it. I don't have a crystal ball. Mine broke, so I can't put a date on it. But I can tell you that I feel like maybe even before the end of the year or going into the wintertime, we should start seeing, in my opinion, prices coming down. If you're in a position to get a house now, I wouldn't hesitate. I would try to do that so that you can get it at the best rate possible. Because going into the next few years, we may see some significantly different rates than we see now, and you're going to be paying a lot more money for that house. And your buying power actually goes down when you're paying higher interest on an even a more expensive home. So makes things difficult. Please, if you haven't already, please like, subscribe to my channel. Thank you all so much for being here. Thank you so much for watching. My name's David Pixler, and you've been watching The Argo.